and it's Chapter 13, which explains financial statement analysis. This is a very interesting area, and it's I think you'll find it intriguing in that financial statement analysis essentially allows you to construct a story about a company. And so investors and creditors cannot evaluate a company by examining only 1 year's data. This is why most financial statements are comparative. That is, they cover at least 2 periods. Many decisions hinge on the trend of revenue, the trends of expenses, the trend of income from operations, and so on. So have revenues increased from last year? If so, by how much? Suppose net sales have increased by $50,000. Considered alone, this fact is not very helpful, but knowing that long-term percentage change in net sales helps a lot. It's better to know that net sales have increased by 20% than to know that the increase is $50,000. It's even better to know that percentage increases in net sales for the past several years have been rising year over year. The study of percentage changes from year to year is called horizontal analysis. Computing a percentage change takes 2 steps. First, we compute the dollar amount of the change from one period, the base period, to the next. Then we divide the dollar amount of change by the base period amount. This exercise 13-16A, we prepare a horizontal analysis of the comparative income statement of McMahon Music Company. Round percentages to the nearest 1/10. And so you can see what we've done is for total revenues, we've taken the change in total revenue between 2011 and 2012 of $90,000, and we divide that by the $917,000 in 2011 revenue to get a 9.8% increase. And then we do that for each of the line items of expenses until we get down to net income. So make sure that you're familiar with this calculation, please. Trend percentages are a form of horizontal analysis. Trends indicate a direction a business is taking. Have revenues changed over a 5-year period? What trend does net income show? These questions can be answered by trend percentages over a representative period, such as the most recent 5 years. Trend percentages are computed by selecting a base year whose amounts are set equal to 100%. The amount for each following year is stated as a percentage of the base amount. To compute a trend percentage, divide an item for a later year by the base year amount. You can perform a trend analysis on any item you consider important. And so next, let's go on to talk about vertical analysis. And so then how do we perform a vertical analysis? Vertical analysis shows the relationship of a financial statement item to its base, which is the 100% figure. All items on the particular financial statement are reported as a percentage of the base. For the income statement, total revenue or sales is usually used as the base. For the balance sheet, total assets is the base. So for income statement, we use total revenue or total sales as the base, and for the balance sheet, we use total assets as the base. Now, this may change from company to company, so the company defines what the base is, but the revenue for income statement and assets for the balance sheet are typically what we see. But don't be surprised if you see that change in other examples. And so next we want to talk about how to prepare common size financial statements. So financial statements can be modified to report only vertical analysis percentage, no other dollars. Such financial statements are called common size statements. In order to perform vertical analysis, you must first convert the financial statements to common size format. On a common size income statement, each item is expressed as a percentage of the revenue amount if revenue is determined as the base. Total revenue is therefore the common size. In the balance sheet, the common size is total assets, assuming that's what the company defined as the base. A common size financial statement aids the comparison of different companies because all amounts are stated in percentages. That is, we have no dollar amounts reflected, thus expressing the financial results of each comparative company in terms of a common denominator. Comparing the dollar amounts of different companies of different size will always result in favoring the larger companies. But comparing the same companies using percentages via the common size statement approach, can equalize the companies to determine operating efficiencies with their respective resources. Benchmarking compares a company to some standard set by others. The goal of benchmarking is improvement. Besides a key competitor, companies also often compare themselves to their industries as a whole to see their position among all the companies doing the same type of business. So now we want to talk about how to analyze the statement of cash flows. And you remember from Chapter 12, we went through several different scenarios of preparing the statement of cash flows. And I hope you remember what were the two methods that were available. Those would be direct and indirect, right? And that most companies prefer the indirect method of preparing the cash flow statement. Analysts find the statement of cash flows more helpful for spotting weaknesses than for gauging success. That's because a shortage of cash can throw a company into bankruptcy, but lots of cash doesn't ensure success. Here are some signs that cash flow signs of a healthy company. Operations are the major source of cash, not a use of cash. Investing activities include more purchases than sales of long-term assets, and financing activities are not dominated by borrowing. And so again, these are just some signs of a healthy company. So next we're going to move into a very interesting area, and that's how to use ratios to make business decisions. And this is ratios. When we're referring to ratios, we're just simply referring to another form of financial analysis. And again, this method is very interesting because it kind of helps us develop and tell a story about a company. So ratios are a major tool of financial analysis. A ratio expresses the relationship between various types of financial information. Many companies include ratios in a special section of their annual report. The ratios we discuss in this chapter can be classified as measuring the ability to pay current liabilities, measuring turnover and cash conversion, measuring leverage or overall ability to pay debt, which we'll talk about in part 2 of this discussion, measuring profitability, and analyzing stock as an investment. Three figures help determine a company's ability to pay current liabilities. That is working capital, current ratio, and asset test ratio. Working capital measures the ability to pay current liabilities with current assets. In general, the larger the working capital, the better the ability to pay debt. Recall that capital is total assets minus total liabilities. Working capital is like a current version of total capital. The most common ratio evaluating current assets and current liabilities is the current ratio, which is simply current assets divided by current liabilities. The current ratio measures the ability to pay current liabilities with current assets. In general, a higher current ratio indicates a stronger financial position. What is an acceptable current ratio? The answer depends on the industry. The norm for companies in most industries is around 1.5 as reported by the Risk Management Association. But be careful here when we're talking about ratios, because the important point to note here is that we can calculate a company's ratios and the different financial ratios that we're going to talk about, but it's the comparison of those to a comparably sized firm in a similar industry and how those ratios compare to one another that tells us really whether the company has a healthy ratio or not. It's not the amount of the ratio or the calculation of the ratio taken on its own in isolation. The asset test or quick ratio tells us whether the entity could pass the asset test of paying all of its current liabilities if they came due immediately. The asset test ratio uses a narrower base to measure liquidity than the current ratio does. So to compute the asset test ratio, we take cash, short-term investments, and net current receivables, that is, accounts and notes receivable net of any allowances, and divide by current assets. Inventory and prepaid expenses are excluded because they are less liquid. A company may be unable to convert inventory to cash immediately, and so that's why those types of assets are excluded from the quick ratio. The ability to sell inventory and collect receivables as well as pay accounts payable is the lifeblood of any retail, wholesale, or manufacturing concern. So in this section, we'll discuss three ratios that measure this ability: inventory turnover, accounts receivable turnover, and accounts payable turnover, as well as the relationship between them called the cash conversion cycle. Companies generally strive to sell their inventory as quickly as possible. The faster inventory sells, the sooner cash comes in. Inventory turnover measures the number of times a company sells its average level of inventory during a year. A fast turnover indicates ease in selling inventory. A low turnover indicates difficulty. A value of 6 means that the company's average level of inventory has been sold 6 times during the year, and that's usually better than a turnover of 3 times. A low inventory can indicate either slow sales or too much inventory on hand. But too high a value can mean that the business is not keeping enough inventory on hand, which can lead to lost sales if the company can't fill orders. And therefore, we can see how interconnected all of these ratios become. To compute inventory turnover, divide cost of goods sold by the average inventory for the period. We use the cost of goods sold, not sales, in the computation because both cost of goods sold and inventory are stated at cost. The accounts receivable turnover measures the ability to collect cash from customers. In general, the higher the ratio, the better. A low ratio could indicate credit policies that are too loose. Extending credit to customers who don't have the ability to pay or could also indicate lax collection practices, not following up on outstanding receivables to promote collection. However, a receivable turnover that is too high may indicate that credit is too tight, and that may cause you to lose sales to good customers. To compute accounts receivable turnover, divide net sales by average net accounts receivable. The ratio tells how many times during the year average receivables were turned into cash. Businesses must convert accounts receivable to cash. All else being equal, the lower the receivable balance, the better the cash flow. The days sales and receivables ratio shows how many business days sales remain in accounts receivable. Compute the ratio by a 2-step process. Divide net sales by 365 days to figure the average sales per day, and then divide average net receivables by average sales per day, just calculated. Accounts payable turnover measures the number of times per year that the entity pays off its accounts payable. To compute accounts payable turnover, divide cost of goods sold by average accounts payable. To convert accounts payable turnover to days payable, divide 360 by payables turnover. And so the last issue we'll talk about in part 1 here of chapter 13 is the cash conversion cycle. So by adding the 3 turnover ratios we just discussed, we can compute a company's cash conversion cycle as shown. And essentially what this tells us then is how long does it take us to convert the purchase of inventory into the cycle of buying inventory from the time we buy it to the time we pay the vendor invoice, including how long it takes us to sell the product and convert that to cash. And so please make sure you've read the chapter and are comfortable with this up to the point we talked about, and in the next section we'll complete chapter 13 in part 2 of our discussion. Thank you.